We will be discussing gap reversals in this video lesson. In order to describe a gap reversal, we first need to have a solid understanding of what a gap is and how they occur. The gaps we are referring to are dramatic shifts in price that occur between the closing price from the previous trading day to the opening price the next trading day. For instance, if a stock closed yesterday at $52 and today opened at $49, then this stock has gapped down $3 on the opening print. So how do these stocks shift so far in price without trades occurring between the gap? Well, through the use of OPG orders or market on open orders, traders and investors have the ability to receive the very first print on the trading day. This is referred to as the opening print for any stock, whether they are entering into or exiting the trade. Typically, these opening prints given to those submitting OPG orders are very fair. However, on occasion, when too many of these OPG order requests are sent all in one direction, the opening print gets pushed too high or too low, making them prime targets for gap reversals. Therefore, when determining your opinion on a gap, it is important to identify the reason for the dramatic shift in price, as well as how price action reacts to the opening so far away from its previous closing price. Now, these gap reversal opportunities arise when the opening print of a stock is substantially higher or lower than the previous day's closing price compared to that of the overall market or sector the stock is in. For example, if the Dow, Nasdaq, and S&P are all set to open down significantly in the morning, then any stock opening down roughly that same percentage should be expected, and thus there is no real play on any gap reversal. However, if the stock opens up, then traders may seek to fade or reverse the stock, as it is potentially a good candidate for a gap reversal. Basically, those who participate in a gap reversal go long if the stock opens down substantially and go short if the stock opens up substantially. Here are 5 things to look for when entering a gap reversal. Since buying a gap down reversal and shorting a gap up reversal have the same signals, we will only mention those for a gap down reversal to avoid being redundant. Okay, 1. The overall market sentiment should be positive. The futures of the major indexes must show some strength both pre-market and during the open. This will help put traders in a mindset to go long. Moreover, if the stock is typically sector driven, such as a commodity stock like steel or oil, compare it to other stocks in its sector. Identify if there is strength throughout the entire sector. 2. The gap down must be a significant percentage of the previous day's close. Usually, anywhere from 2 to 5% are gap downs that have the best chance of reversing. Stocks that drop more than 5% on the opening print typically have less potential of reversing and are more risky, as there is most likely a good reason for that stock to be down so far. And thus, there must be a significant force driving that stock lower. 3. There must be bid support after the opening print, or very soon after that. Make sure not to enter the trade if there is not an exit in sight, especially if the spread is more than 7 cents apart, as the stock can quickly turn against you before you can even think about exiting. Therefore, if buyers are not aggressive early, do not go long in hopes that eventually they will. It is much smarter and safer to wait for at least some signs of strength before you enter long. 4. After the large volume spike on the opening print, the offer side of the limit book should be light, as all the sellers and shorts should be finished. You do not want to see much resistance on the chart, limit book, or ECNs, which could slow down the gap reversal. The best reversals occur quickly and dramatically. And 5. It's a great sign to see new bids step in, looking to buy both through the ECNs and the limit book, as well as buyers taking out offers on the tape. This increases the probability of a successful reversal as it indicates buyers are getting aggressive and are attempting to close the gap. Now let's take a look at some examples of gap reversals. From this first slide, we see a snapshot of Burlington Northern, ticker symbol BNI, prior to it being bought out by Warren Buffett and Berkshire Hathaway. From the chart, we see that the stock opened down over $4 as the closing price on the previous day was $81 and the opening price the next day was slightly above $76. Moreover, by looking at the chart, we see that within the first minute, the stock begins to spike up as buyers recognize the opportunity to fill the gap due to the lack of selling pressure. While it is difficult to foresee the stock appreciating over $8 from the opening print, like in this example, it is fair to expect the stock to make an effort to fill most, if not all, of the gap on a good reversal. Moving on to the next stock, ticker symbol COH, which stands for the retailer Coach, we see that from the chart, the stock opened down over $1.25 as the closing price on the previous day was $18.60 and the opening price the next day was around $17.20. Now, unlike in the previous example, where the stock never hit a price lower than the opening print and instantaneously surged upward, this stock within the first minute or two jostled around in about a 20-cent range, testing both higher and lower. But soon, buyers quickly realized the lack in selling pressure, considering how far down the stock had opened, and broke through the mini resistance level created by a large seller at $17.20. This confirmed strength in the eyes of many traders as they then spiked the stock back up, not only filling the gap, but also temporarily moving it up positive over $1 on the day. And in the last slide, we see a perfect example of a gap up reversal in McAfee, ticker symbol MFE. Notice on the chart how the opening print at $33.98 was the high of the day for the stock, after opening about $1.20 up on the day. The stock immediately fell and within 2 minutes had dropped over 75 cents. Furthermore, after a temporary support level was broken through at $33.20, the stock filled its gap and some, managing to go over $1.50 within the first 30 minutes of the trading day. So after seeing this, you must be asking, how and why can stocks sometimes print so far up or down if they instantly turn around and go back in the other direction? Well, the answer is simple. Too many orders in one direction pre-market can create one big bubble of market orders, causing these stocks to open at prices that ultimately are not very fair. Traders who recognize the lack of continued pressure pounce on the opportunity, thus causing stocks to quickly fill their gaps. Once the reversal starts moving, it then becomes a snowball effect, making it difficult to turn back. Therefore, as a trader, you should encounter a scenario where you identify all the signals that warrant reversing a stock that has gapped far from its opening print. Therefore, look to be aggressive as you have found a great reward to risk ratio. By placing a stop loss just 1 cent below the lows of a gap down reversal and 1 cent above highs on a gap up reversal, you manage to only put at risk a few cents to potentially capture a few points in profit.